Everything has to be paid for. In Gaza, an estimated 70% to 80% of residential buildings sustained significant damage or total destruction between 2023 and 2024, according to UN Satellite Center imagery analysis. That is not just a housing crisis, it is the simultaneous destruction of the wealth, collateral, and economic foundation of 2.3 million people. A home is not simply shelter. In economic terms, it is a family's largest asset, the basis for mortgage credit, the collateral for small business loans, the store of generational wealth. When you destroy housing at scale, you do not just displace people, you eliminate their economic standing. This episode examines how residential infrastructure destruction functions as a mechanism for permanent economic reset, why the recovery timeline for housing far exceeds that of industrial or commercial infrastructure, and why the housing trap is one of the most durable economic consequences of modern conflict. Destroy a factory, the economy loses production. Destroy housing, the economy loses its foundation. Housing as economic infrastructure. Housing is the single largest asset class in most economies. In the United States, residential real estate represents approximately $40 trillion in value, more than the combined value of all commercial real estate, all publicly traded stocks, and all business assets. In developing economies, the ratio is even higher relative to GDP because housing represents a larger share of household wealth. This is not incidental. Housing functions as economic infrastructure in several critical ways simultaneously. It is collateral for mortgage lending, the primary mechanism through which households access credit. It is the foundation of wealth accumulation for middle-class families. It enables geographic mobility tied to employment, and it provides the physical space within which small businesses, the majority of employment in most economies, operate. When housing is destroyed at scale, all of these functions collapse simultaneously. The World Bank's post-conflict recovery framework identifies housing reconstruction as the single largest cost category in most post-conflict recovery plans, typically representing 30% to 50% of total reconstruction budgets. And even when housing is physically rebuilt, the economic functions it previously served do not automatically resume. The Gaza calculation. Gaza's housing destruction between 2023 and 2024 represents one of the most concentrated residential infrastructure losses in modern conflict history. UN Satellite Center analysis indicated that by early 2024, approximately 70% to 80% of residential structures in Gaza sustained damage ranging from partial to total destruction. The physical rebuilding cost alone, constructing replacement housing for 2.3 million people, is estimated by the UN, World Bank, and Palestinian Authority at between $15 billion and $20 billion. This figure assumes standard construction costs and does not account for the security conditions, supply chain restrictions, or labor shortages that will extend the actual timeline and inflate the cost. But the physical cost is only the beginning. Gaza's pre-conflict housing stock represented the accumulated wealth of generations of families. Each destroyed home eliminated not just shelter, but the economic standing of the family that owned it. Property values, savings embedded in real estate, and the collateral basis for any future credit, all erased in months. They said housing reconstruction would be the centerpiece of Gaza's post-conflict recovery, restoring living conditions and economic stability within 5 years. They got a reconstruction timeline estimated at 15 to 20 years under optimistic conditions, a total cost exceeding $15 billion, and an economic reset that will take a generation to reverse, not because building is difficult, but because the economic functions of housing cannot be restored simply by replacing the structures. The Beirut lesson. The August 2020 explosion in Beirut's port destroyed or damaged an estimated 300,000 homes across the city, roughly half of all residential units in the capital. The blast was not a military strike, but the economic consequences followed the same pattern as conflict-driven housing destruction. The World Bank estimated total property damage from the Beirut explosion at $4.6 billion to $5.4 billion. Housing accounted for the majority of this figure. In the months following the explosion, the Lebanese banking system, already in crisis, refused to release depositors' savings needed for reconstruction. Insurance coverage in Lebanon was minimal, with property insurance penetration below 5% of residential units prior to the blast. The result, 300,000 households lost their primary asset with no financial mechanism to replace it. Mortgage lending ceased in affected areas. Property values in surrounding neighborhoods fell by 30% to 50%. Small businesses that operated out of residential premises closed permanently. The housing destruction did not just damage Beirut, it removed the economic foundation on which recovery depended. They said, international reconstruction aid would restore Beirut's housing stock and allow the city to rebuild within 3 to 4 years. They got a reconstruction stalled by banking system collapse, insurance failure, and political dysfunction, with less than 20% of damaged homes fully restored 2 years after the explosion, according to Lebanese government tracking data. The wealth destruction mechanism. Housing destruction in conflict zones eliminates household wealth at a scale that no other form of damage matches. This is because housing is not a depreciating asset like equipment or vehicles. It is in most economies an appreciating one, a store of value that families build over generations. The World Bank's analysis of household wealth in conflict-affected populations shows that families who lose housing in conflict experience wealth reductions of 60% to 90%, regardless of whether other assets survive. This is because housing typically represents 50% to 70% of total household wealth in developing economies, according to OECD household balance sheet data applied to comparable income levels. When this wealth is destroyed, the economic consequences extend far beyond the household. Credit markets contract. Banks stop lending in affected areas because collateral no longer exists. Small business formation drops by 40% to 60% in the years following mass housing destruction, according to World Bank entrepreneurship data from post-conflict zones. The economic ecosystem that housing supported, local commerce, services, employment, contracts with it. The reconstruction trap. Rebuilding housing is not simply a construction problem, it is an economic sequencing problem, and the sequence almost always fails. Housing reconstruction requires capital. Capital requires credit. Credit requires collateral. Collateral requires existing property value. In a zone where housing has been destroyed at scale, none of these prerequisites exist. The cycle is broken at every point simultaneously. International aid can fund construction, but it cannot restore the credit ecosystem, the property market, or the wealth base that housing previously represented. Rebuilt housing provided by aid programs is typically rental or subsidized, not owned. It does not function as wealth accumulation or collateral. It is shelter, not economic infrastructure. The Rand Corporation's analysis of post-conflict housing recovery shows that full restoration of housing's economic functions, credit access, wealth accumulation, property market function, takes 10 to 20 years beyond the completion of physical reconstruction. Physical rebuilding may take 5 to 10 years. The economic recovery takes twice as long. They said once housing was physically rebuilt, the economic functions it previously served would resume automatically. They got a 10 to 20-year lag between physical reconstruction and economic normalization, during which populations remained economically displaced even as they were physically housed. The displacement cost. When housing is destroyed, people do not simply wait for rebuilding. They move into displacement camps, temporary shelters, relatives' homes, or neighboring countries. Each of these alternatives carries its own economic cost, and none of them replaces the economic function of permanent housing. Displacement camps are among the most expensive forms of temporary housing. The UN estimates that maintaining one person in a displacement camp costs between $15 and $50 per day, depending on location and services provided. For Gaza's displaced population of over 1.9 million people as of early 2024, the daily camp maintenance cost alone runs between $28 million and $95 million. Over months, this adds up to billions spent on temporary solutions that produce no wealth accumulation, no collateral, and no economic foundation for recovery. Beyond the direct cost, displacement disrupts employment, education, and social networks. The World Bank estimates that displaced populations experience a 30% to 50% reduction in productive capacity compared to housed populations, not because they are less capable, but because the physical and social infrastructure that supports productive work has been removed. Displacement is not a pause in economic life. It is a sustained reduction in economic output, sustained as long as the displacement lasts. The generational reset. Housing destruction in conflict is not a setback, it is a reset. Families that spent decades accumulating wealth through property ownership are returned to economic zero or below it if they carry debt from pre-conflict mortgages on properties that no longer exist. The IMF has documented this pattern across multiple post-conflict economies. In post-war Bosnia, households in areas of heaviest residential destruction took 15 to 20 years to return to pre-conflict wealth levels, and many never did. In post-invasion Iraq, property disputes generated by destruction and displacement created legal and economic conflicts that persisted for over a decade, consuming judicial resources and preventing clear property ownership. This is the housing trap. It is not a problem that money alone can solve. It is a structural economic reset that requires not just reconstruction, but the rebuilding of an entire financial ecosystem, credit, insurance, property markets, legal frameworks that conflict destroyed alongside the buildings themselves. Each destroyed home is not just a structure, it is a family's economic position, a neighborhood's commercial foundation, and a city's wealth base, all erased simultaneously. And restoring what was lost requires not just bricks and mortar, it requires decades. Subscribe to the price of conflict. Because the most expensive thing conflict can destroy is not the thing that looks most impressive burning, it is the thing every family built over a lifetime.